Welcome, everyone. Thank you for joining us to discuss the coronavirus, global economy, and scenarios for Europe. We're very excited to have today powered by Berenberg Bank, and we have Dr. Schmieding, the chief economist of Berenberg Bank, joining us. For those of you who do not know, Berenberg Bank was founded in 1590 and is active in investment banking, particularly pan-European equity brokerage and capital market transactions, in addition to private banking for wealthy customers and institutional asset management. A reference to the economy and to the market, we're very excited to have Berenberg represented during this webinar. One quick thing before I introduce to you Dr. Schmieding and the topic. The Livestorm app that we're using here for this webinar has quite a few features to engage with Dr. Schmieding today. So you can ask questions, feel free to not only ask these questions, but also rank and vote on the questions that you feel are most relevant. We have a couple of poll questions as well, if you would mind taking the time to answer them. We're keen on getting some of your feedback regarding what is happening. And we will be sending out a post-webinar recording as well as access to the document, the slides that we will be sharing with each and every one of you today. So we're very excited again to have this webinar and for taking the time to come and speak with us. For those of you who need to be reminded, once again, this is on the coronavirus and the impact to the global economy and some scenarios for Europe. So again, Dr. Schmieding, we give you the virtual floor here and turn the time over to you. Thank you for taking the time to speak with us. You now have the next 30-35 minutes and we'll use questions at the end.
That we have to cover today. And the reason that we have to pay a lot of attention now to the world economy is unfortunately rather bad. This is a very unusual shock facing the world economy. It's a shock to demand and supply. Let me, before I get a bit more into the economics, go with you through some of the slides at the beginning. For instance, we see in the pandemic update on the next slide, we see the number of cases. This is affecting a lot of people relative to, say, global population or population in the various countries. It may still seem small, but the rate of increase, at least until recently, has been catastrophically exponential. You may have heard probably the forecast of some virologists that if unchecked, this could easily affect 60–70% or more of people in any country until there is some immunity that has been built up and the slowdown and the surge of the virus eventually peters out. We have to take this very seriously. After the first epicenter of the pandemic, China, the next epicenter was then Europe, starting in Italy, and then moving on to Spain. And by now, the third epicenter is the US, which in terms of the trajectory seems to be about 7–8 days behind the trajectory seen in Europe. What we see is, as an economic impact in some of these charts, in global manufacturing, for instance, you see two things. First of all, when you look at the downsides there, you do see that there was a massive plunge 2008–2009. That was the great financial crisis. Then you see the beginnings of a significant downturn now at the very end. This is only what we're seeing there at the very end in the slide here in global manufacturing is only the beginning. This is data mostly for March and mostly taken in countries where the lockdowns had not yet been fully in effect while the survey was taken, and also in manufacturing, which probably will be hit much less by the lockdowns than a lot of activities in the service sector. After all, many factories are still open and allowed to operate across much of the advanced world. However, we have serious lockdowns affecting services. So what you see here on the global manufacturing, the beginnings of a downturn is only the beginning. It is likely to get, over the months of April and probably May, it's likely to get much, much worse in global manufacturing. And on top of that, it's likely to get much, much, much worse in major parts of the service economy. There is some ray of hope coming out of China, which you see on the next slide. Look at the blue line. In China, there was a significant drop in February while the virus was raging almost unchecked in China, or when the measures to check its spread were not yet in place long enough to be fully effective. You see the serious drop in the blue line, manufacturing activity in China, measured by what purchasing managers are saying about that. And now you actually see for March in China a rebound. The rebound, however, should not be interpreted in the sense that it's back to normal. No. What this line, if it's around 50, suggests is it's neither worse nor better than the month before. So the evidence of China is that at the moment, economic activity is starting to stabilize. It is probably creeping up a little. There are quite a few indications suggesting it's creeping up a little, but it's only so far for what we can see from here and how we can interpret these surveys. It's only the modest beginning of a new upturn. Let's go a little further in the slides, please. Yes, and let me at this slide tell you a bit of the key story before we then present some of the details. We do have a shock to the real economy across the advanced world and across much of the developing world that is unprecedented in peacetime. It is a shock that affects demand and supply in the same way. If you can't go to a shop, is that less demand for the shop? It is. But it's also, the shop is closed. It's less supply of their services. It is a parallel shock to demand and supply that we have not seen before. It's not comparable to previous recessions. This is a recession that is happening for completely non-economic reasons. Often you have a recession needed to cleanse financial excesses. For instance, after the bursting of the dot-com bubble, after the bursting of the US subprime bubble. Sometimes you have recessions that are the result of serious policy mistakes. For instance, the real reason why the great financial crisis was so great was not that the subprime excesses had to be corrected. The real reason why it was more than a garden variety recession was that the US policymakers reacted the wrong way by closing down Lehman without taking care of counterparty risks. That's not how you should do it. If you have to close down a bank, what you should do is keep its business open, fire the owners, fire part of the staff, but keep the business open for long enough to have an orderly wind down. So sometimes it's policy mistakes that make a recession worse. Sometimes it's the need for economic cleansing that causes a recession. Sometimes it's excessive wage pressure that central banks need to combat. Sometimes it's a consumer boom that is going inflationary that needs to be corrected. None of these excesses were there at the start of this crisis. At the margin, we had some excesses in the US corporate debt market, in the financing of US fracking. We had some excesses over there in debt-financed equity buyouts, in equity buybacks. But we did not really have an economic reason for a recession. So this actually is an advantage. It means that from a purely economic standpoint, once the non-economic reason for this sharpest recession in probably living memory in the aggregate world, once the non-economic reason is over, we should see a rebound. When shops open again, when supply chains are active again, when we can go back to school, to university, when we can go back to many activities, we will have a recovery in supply and demand. What we need to watch, however, is the risk that this non-economic event, this health emergency, and the recession, the lockdowns needed to contain the pandemic, that this creates second round problems, which could then exacerbate and prolong the downturn. One such serious risk would be if we were to get a financial crisis on top of that. Now, there needs to be a lot of liquidity support for companies, for households. Quite a few credits will go wrong in the sense that at least for a while, without such support, companies or households won't be able to pay them. There have been strains in the financial system, for instance, in the US corporate debt market. There are some strains in European sovereign debt markets, with the Italian yield spread having blown out for a while and the Greek yield spread. But policymakers have reacted to these incidents by doing unusual things. In the US, the central bank is now buying corporate bonds. There have been unusually huge liquidity injections, dollar swap lines, so that there is no dollar scarcity in the outside world beyond the US, where the Federal Reserve is supplying dollars anyway. We have had massive purchases of the Italian and other bonds by the European Central Bank. We do see that policymakers are rising to the challenge in the sense that they are doing what it takes to prevent the follow-up financial crisis, which might otherwise follow from the shock to the real economy. We are confident that policymakers will be able to prevent this for quite a while, and probably for good, so that there will not be a serious credit crunch causing another downleg of the economy once the pandemic itself is sufficiently contained. Along similar lines, we do expect the measures to help the unemployed contain the rise in unemployment in Europe by simply offering companies to pay for the people on the job, even if they no longer work. These schemes modeled along the German underemployment on the job scheme, Kurzarbeitergeld. We expect the liquidity help for companies, to prevent the wave of bankruptcies and dismissals that is to some extent inevitable, to get so much out of hand that this in itself causes another significant follow-up recession. So the key call is policymakers will do and are doing whatever it takes to keep this a medical event, in the sense that once the medical emergency is starting to be under control, that then lockdowns can be eased. And once lockdowns are eased, we will discover that supply and demand will come back. They will not all come back at the same pace. We will initially have private demand, households, businesses, lag behind the rebound or the reopening of supplies. The restaurant may be opened again, but it's probably not going to be crowded again for a while. That's at least to some extent the experience that we have from China. But we do expect that this gap that will be there for a while between supply being step by step, gradually, in Europe probably from sometime in May onwards, supply being switched on again, step by step by step, that this will be followed by a rise in demand that lags behind, but that will eventually catch up with supply, especially as the governments will, to some extent, offset the initial reluctance of households to spend and of businesses to invest by governments simply spending more. More government investment, more government spending on the health system, on welfare and other issues. Our key forecast is that 2 years after the trough, economic activity will probably be back to where it was pre-corona, and that thereafter we will still face a period of, say, 2 to 3 years where economic growth from back to the pre-corona level will be roughly in line with, will be slightly above actually what used to be trend growth before, as there will still be some unemployment, open capacities that we can grow into. What you have seen here over the slides that are thankfully being pointed out is for you to a lot of the policy responses that we have. You can look at them at more detail at your leisure. We are ready to send them around with the compliance approval. It is simply the pure length of the slides that we have gone through already on the policy response suggests that it will be significant. Now, getting back to the discussion about the level of GDP pre-corona being reached again within 2 years after the trough. First, when do we expect the trough? We expect the trough to be right now in the second quarter of this year, probably in the month of May, late April, early May. Then we look for restrictions to be eased gradually so that the second half of the year will already be better, much better than the first half. Let's go back one slide. Let's go to the GDP numbers over there. All forecasts for GDP growth at the moment are highly, highly tentative. They may easily be much, much worse. We do simply not know the extent of the economic damage of the lockdowns. We don't have an experience for that. We do not know how it's going to be counted by the bean counters, that certain activities are not there. We may miss part of the surge in internet shopping because we're not used to count it. The risk is that initially, at least for the month March to May, the data will simply be horrific. Our forecasts, which you see over here, incorporate some improvement from June onwards. If this is not the case, if, for instance, economically restrictive lockdowns can only really be eased, say, a month later, you would have to revise these forecasts a lot to the downside. As a rule of thumb, for every month of lockdowns, take down the GDP forecasts for the average of this year by 2.5 percentage points, and in countries with significant dependence on summer tourism, probably by 3 percentage points or more for every month of lockdown. This is serious stuff. Now, let's go a bit further in the slides. Tough month ahead, yes. We have to brace ourselves for it. The data will be bad. The longer-term impact, however, is interesting. It may not only be negative. On the one hand, thinking about the beyond the 2 years that we foresee for the rebound after the trough, we will likely have a number of longer-run issues. One of them is, of course, that in the goods sector, we will have deglobalization. That is, we will think about our supply chains. Do we want to be all in China? Not really. Do we want to have a few things closer to home? Definitely. Do we want to have a second supplier, just in case the first supplier hits problems? Yes, we certainly do, even if the second supplier isn't quite as cheap as the first one. Do we want to have more inventories? More likely, yes. We will probably have some retracement of this huge globalization in the goods sector that went on until recently. This is on top of the sort of deglobalization that has already started in response to trade wars and to some extent in response simply in recent years to China no longer being that cheap. So some deglobalization is probably negative for long-term growth. It means that some opportunities to save costs, to be more efficient, will not be exploited in the future. On top of that, we have probably a significant expansion of government spending. Some of that will be good, for instance, if it's on infrastructure and well spent. Some of that will be good, healthcare, even if that is not immediately visible in an improved economic performance. Some of the government spending will, or some of the expansion of the government sector will probably be a bit of a drag on growth, especially if some of that eventually is financed by tax hikes, which probably eventually it will. So we have a number of factors that may hold back global growth after the crisis for quite a while. However, there is one other factor that I would like to point out, and this is the factor that is visible and audible just as we speak. I have never used this technology before. Yesterday was the first trial. We are probably seeing the spread of innovation much faster than before, if even people my age are now turning much more digital than we were. We will likely see this trend across the economy. Crises are the mothers of invention. They are the factors that spread innovation. If you're forced to think anew, to use new technologies, if your working patterns, your normal patterns, the way we always do it, if that is shaken to the core, new things will emerge, and with trial and error, we will find technologies, innovations, patterns of working together, to some extent remote, that will be more efficient than in the past. So my ultimate hope is that over a number of years in the future, we will actually have somewhat stronger rather than weaker trend growth coming out of this. But that, of course, is no consolation at the moment when we face the dramatic human toll of this pandemic. Let's go a bit further in the slides. So a comment on markets here. Equity markets have calmed down a bit. They're still highly volatile with a bit of green recently. They are no longer quite as panicky as they were when we sometimes had, say, a 12% plunge on a day. For an economist, it's difficult to really call the equity market. However, I would venture to say that I do not think that equity markets as a whole should, in the longer run, be 20 to 30% down on what they were pre-corona. I do not know whether or not markets may have been overvalued before. That's everybody's guess. My view, however, is that it is highly unlikely that the productive capacity of, well, our private economies in the Western world will be worth 20 or 30% less than it was before. There will be quite a few instances where higher debt will weigh on companies. There will be some companies which will simply have government capital injected, and where then the rebound or the gains from the rebound will be shared by more owners, including the taxpayers. That is, we face some capital dilution. We will have more debt, but the extra debt will likely be at comparatively low yields and hence should be bearable. All in all, I do not think that equity markets should really be down 20, 30% below what fair value would have been pre-corona. Can we go one slide further, please? We have the issue of fiscal deficits, of the surge in debt. Almost all the costs of this pandemic and the crisis response will probably end up with, well, taxpayers. This is something that hits countries as a whole, societies as a whole, and, well, that's taxpayers. Our attempts to ease the rise in unemployment, to support the unemployed, to support underemployment on the job so that there are few dismissals, to inject liquidity into companies, all that is expensive. We look for fiscal deficits of around 12% of GDP in the US, the UK, Spain, Italy this year, 8% in Germany this year, which had a much better starting position. In any case, the fiscal deficits will be huge and the public debt burden will go up dramatically by 15 to 20 percentage points of GDP over 2 years. Will that be a huge problem? At least not for a while. We will all be a bit more like Japan, probably. Japan is a country with a massive mountain of public debt, where, however, about half the public debt is held by the government itself, more precisely by the central bank, and which hence isn't really on the market. And Japan, despite that, does not have an inflation problem, to put it mildly. What we will likely see is that households, companies, and the financial industry will, during and after this crisis, want to hold more precautionary balances, more liquidity, more cash or cash near instruments to be on the safe side. As a result, the extra liquidity which central banks are injecting into the system, largely by buying bonds, the extra liquidity will be willingly held by the private sector, the financial system, and hence it will not create an inflationary potential. The situation will be stable for quite a while. If eventually the demand for precautionary balances subsides, then of course central banks would have to shrink their balance sheet a little. That probably, judging by the Japanese experience, will take time if it ever happens. Longer term, we may face a few inflation risks coming out of this, out of bloated central bank balance sheets, out of eventually, say, the negative impact of deglobalization in goods, out of, completely unrelated to the coronavirus, out of simply demographic factors. As the world is aging, the advanced world at least, and China, there will be a ratio of pensioners to active workers which will be less favorable economically in the future than it is now. There will be some inflationary pressures over the medium term, say 5 years plus. Not huge, but we may go from Europe around 1% inflation to 2.5%. But this is not immediate. This is 3-5 years hence. Once we get there, well after the crisis and the rebound, once we get to slightly higher inflation, we will probably then see a bit of a rise in yields, and we will then probably have pressure on the private sector to restructure. We may have a significant churning of companies. Those who took on a lot of debt now will be under pressure. Some of them will go under, whereas companies which were strong enough to not take on a lot of new debt now, whereas those companies will outshine their competitors. The same for governments. Over the next few years, central banks will see to it that we do not get into any serious sovereign debt problems. But say 5 years from now, possibly 3 years from now, when the economy is on a more normal footing again, this may start to change. Longer run, I do expect the US and Italy, to name two obvious candidates, to have some fiscal problems. Italy, because its trend rate of economic growth is just too low to really bear its elevated debt burden forever. And in the US, the fiscal starting situation pre-corona was already so bad, planning a fiscal deficit of 5.5% of US GDP with 2% growth. The fiscal starting situation was so bad that with the demographic change in the US, the burden, especially on Medicare, will be so huge that the US will need some fiscal retrenchment, say 5 years from now, perhaps 3 years from now. Otherwise, the bond vigilantes may come back. Now, let me stop my speech with a few summary comments. I'm pessimistic on the very near term in the sense that the drops in output that we will see for March, April, and into May will be beyond those that we have seen in previous recessions. In this sense, it's worse than the global financial crisis 2008-2009. I'm sort of optimistic, however, that policymakers will not make a huge mistake this time. They will do whatever it takes to prevent the medical emergency from turning into a financial crisis and from causing such a wave of bankruptcies and surge in unemployment that this itself then creates another serious downback. And I'm sort of optimistic that countries that get their policy response roughly right will, 2 years after the trough, be able to return to the level of GDP that they had before. There is one thing I worry about, but it's a bit too early to discuss. This will have political consequences. We will remember 20 years from now this crisis. Good crisis managers can build a reputation for decades. Bad crisis managers may be out of office soon. Also, within Europe, if we do show enough solidarity, this can strengthen European integration. But if we do not show enough solidarity, this could be dynamite for the European Union in the end. 2 weeks ago, Eurozone finance ministers failed to send a signal of solidarity. We had a backlash in public opinion in Southern Europe against the North as a result. If today finance ministers finally send a strong signal of solidarity, then this may be mitigated. For me, longer term, the key point is beyond the mere economics, we also have to watch the political fallout, which is too early to gauge now, but which of course is an interesting issue to watch. With that, let me stop my prepared presentation. Let me simply look at some of the questions that you've already been asking. So give me a few seconds to just view a few of those, and then I will speak on these questions that I see before you may then, moderator, please get into the act yourself.
For sure, so, I can gladly help you, Dr. Schmidt. Thank you so much.
That I get.
Yes.
Okay.
While you look at them,
that you think I should answer first.
Sure, I can do that gladly. I think before we get into the question, just so you have a kind of a pulse on the audience here, we've asked a few questions to the audience as well. And one of the things that I'll read to you. It says, the economic effects of COVID-19 coming from reduced spending will be larger than those coming from disruptions to supply chains and illness-related workforce reductions. 42% statement, 25% actually strongly agree, and then 21% are uncertain. Not many disagree with that statement. So not many disagree that the economic effects of COVID-19 coming from reduced spending will be larger than those coming from disruptions to supply chains and illness-related workforce reduction. So interesting. I'm curious. I wish I had seen how it has changed throughout your message with us today. It would have been interesting to see. And then we have 3 more questions that we've asked the audience here. The next one is, the economic policy institutions of the Eurozone are well equipped to ameliorate the potential economic damage from COVID-19. 41% are uncertain. I think kind of mentioning the last thing that you shared with us now. 22% disagree and 24% agree. So either we're uncertain or we're split, right? In this specific topic here. Which of the following are the most concerning threats of COVID-19? Financial system shock, real economy freeze, liquidity problems, or capital problems? 68% believe a real economy freeze is the most concerning threat of COVID-19. 51% believe liquidity problems, and then 9% for financial system shock and capital problems. So most believe that a real economy freeze is the most concerning threat of COVID-19, and liquidity problems are also very high on the concerning threats.
Thank you.
And then the last question that we have, I'm sorry, and then we'll get to the questions, is just, is the global economy already in recession? 88% believe yes, 12% believe no. So I think this gives you an idea of the group that you are speaking to, and we'll look at some of the questions that they've asked now. Would you like me to moderate that, or do you prefer to take them?
Let me first of all make a few comments on the questions that you've just highlighted and the responses, sort of give a bit of my take on it, and then I would like to turn it over to you to then pose the questions that you think are, well, the most pertinent at this stage. First of all, yes, indeed, the lagging of demand will be a serious issue when we switch on again parts of the economy. I do hope that public demand will mitigate that, not immediately, but will mitigate it over the course of next year, so that aggregate demand, private and public, will not be lagging that much for long. Next issue, are the institutions of Europe, the EU, good enough to deal with this? That's an interesting one. Actually, they are good enough in one sense. The European Central Bank has a lot of firepower. If the European Central Bank wants, it can buy all the bonds Italy needs to issue, and Spain needs to issue, and Greece needs to issue. If that means that due to their rules, they also have to buy all the German bonds that will be issued, okay, not optimal, but may happen. Also, the European Stability Mechanism is already quite powerful. They will probably have a decision tonight to allow countries to activate it with light conditionality. So you could argue that many of the things that we would need to enable Italy to borrow the money it needs at acceptable rates are there. What really is lacking is the signal of political solidarity, that Northern Europe admits this is not sort of the Euro crisis, where it was the South needing to shape up. This is a common problem which requires a common response, a common signal, and should thus have instruments that are good for common policies rather than instruments such as the European Stability Mechanism that were designed to help individual countries with specific problems. So it's the institutions sort of could cope, but it would be better, politically better, to have a strong signal of solidarity. And as to what's the worst issue, it depends a bit on the timescale. Initially, the bad issue is, of course, the freeze of the real economy, which then develops into a liquidity problem. And if we do not do anything about it, it would develop into a capital problem. So this is where my sort of faith in policymakers comes in, that the liquidity problem will be eased early enough, not for all, but for enough companies so that this does not turn into a system, economy-wide capital problem. So much from me on the questions that where you had the audience answering them in the meantime. That was my personal take. Now, please take over, moderator.
Excellent. Thank you, Dr. Schmid. I appreciate it. I think in line with some of the comments that you just made, we have one question from Hemang Hirani, who asked, and a lot of upvotes on this question, but he asked, are the economic stimulus packages by central banks globally likely to be sufficient in helping avoid a global recession? You've kind of touched on this over and over again. Then he goes on to say, what more could be done from central banks? You've mentioned the political solidarity, right, as kind of the glue to this, but is there something else that could be done from these central banks to stimulate these economies?
Basically, not really. First of all, of course, the recession cannot be avoided. We are in a serious recession. That is simply, if you switch off economic activity falls. That's the recession. What we are doing with the policy response is preventing the lockdowns to be followed by an economic recession or a financial crisis. That's where I think policymakers are basically doing all it takes. What's really needed there is the readiness to look, is it working on the ground? And if it's not working on the ground, to better it. We had an example yesterday in Germany. We started with public guarantees for credits to small and medium-sized businesses, 80%. It was then upgraded to a 90% guarantee. We now have 100% guarantee, government guarantee for bank credits to small and medium-sized enterprises, because simply we had learned that if the banks have to show the 20% or even 10% of the risk in the current environment, they're not doing it. There are many other examples in many countries. What we really need is not the big announcement of another package. What we need is the readiness to adjust the current tools so that the money really flows to the companies and the people who need it. Then what is being prepared, but does have, say, a few weeks or even months time, is that for the recovery phase, once we can ease the restrictions somewhat, for the recovery phase, we need government support with infrastructure investment, other investment programs. These are being discussed. I'm confident they will be passed, but this is where we still need to see more than we already have.
Excellent. Thank you. Very, very good insights. We have a couple more questions, time permitting. This one from Miguel. He's asking, forward, will we witness an asymmetric shock between Europe and the US?
Hard to say. We have already witnessed to some extent an asymmetric shock in the sense that Europe, much of Europe, is reacting better to this than the US. European welfare states can be a drag on growth, but in such a crisis, it's good to have it. What you see in the US is a massive surge in jobless claims, unemployment. What you see in Europe is some surge in unemployment, but more of that is surge in people who stay on the job, but receive benefits for underemployment on the job. and who are thus, because they have not been dismissed, not unemployed, and a bit less unhappy about it than their counterparts in the US. Having a welfare state with a bureaucracy that can administer such programs is better than having only a small bureaucracy used to administer such programs. So in that sense, probably Europe has a bit of an advantage over the US in this. Of course, the US, being a flexible economy, will eventually also recover nicely, but initially I would say there's actually a bit of an advantage Europe in this.
Excellent, excellent. A couple more questions here we have from the audience. Shreyans has asked, from a fundraising perspective, how do you see the private company valuations being impacted globally, especially in emerging markets? And do you suggest, or would you suggest, founders go for fundraise in the next couple of months, since lower valuations might be a disadvantage?
Well, if you can avoid it, I would not want to raise funds at the moment. It's probably at the moment better to get the credit at very, very low interest rates for a little while and do the capital raising a bit thereafter. If you can, that's what probably should be done, at least from the economist's point of view. There is one interesting point, if I may expand on that. This is on emerging markets. They are a very diverse bunch. I think that the depths of the recession, as well as the quality and speed and extent of the recovery, will depend a lot on the quality of governance in a country. Well-governed countries and societies are likely in the lead. This, for instance, should probably hold to the well-run economies of East Asia, such as Taiwan, such as South Korea, probably also Japan, maybe Vietnam, to some extent China. I think well-run countries will get through this better. And these include some emerging markets. In Europe, we see that Central Northern Europe is probably all in all coping a little better than Southern Europe. The US is probably kind of a mix between Northern Europe, Southern Europe, and a bit of some of the weaker emerging markets. The US will cope, but all in all, probably with slightly more difficulties than the US, with slightly more difficulties than Europe. And as we go through emerging markets further, those in Europe will likely mostly do well, especially East Central Europe. Emerging markets elsewhere, especially where health systems are weak, where governance systems are weak, Brazil comes to mind, could be affected by this more deeply and for longer than other countries. So it's a very diverse outlook for emerging markets. They are not one asset class. In this, I would say they are 2-3 separate asset classes, depending on basically how you rate the governance structure of the country that you're thinking of.
Excellent. A couple more questions. This one from Phil. What is your short and longer term view for the euro, the pound, and the US dollar?
This is not much a currency event. This is a little currency event in the sense that typically currency flight out of emerging markets into safety benefits the US dollar more than the euro. This is what we have seen to some extent, but it's not a huge move. I would expect over time that the euro recovers the losses to the US dollar, and that longer term, the euro actually approaches fair value, at least to some extent. Fair value is nowhere near 110. Fair value to the US dollar for the euro is closer to 120. So on a 1 to 2 year view, I would expect, with the fading of the unusual circumstances, the euro to be a bit up again. As to sterling, that's a Brexit question. I would actually say that in the end, this could strengthen sterling a little bit, simply because after this, there is a chance that the Brexit, the economically relevant Brexit, the leaving the single market, will be delayed, will not happen at the end of this year, and that both sides, and especially the British side, will be a bit more pragmatic after this shock about their future relations, that ideology will play less of a role after this common shock. And if it's a softer, less ideology-driven Brexit, that is exit from the common market of the EU, if it's less of that hard Brexit economically, then it's good for the UK economy and it's good for sterling.
Excellent. Do you still have some time? I think we have about before we have to end, and we'll ask just a couple more questions if that's okay.
That's
one
okay.
of them. Perfect. One of the big ones that we've had here are the key issues for business continuity and strategy, and I think this is one. If you might address this, I think it applies as an umbrella to all of the viewers that we have today. But what are some of the key issues for business continuity and strategy in your opinion?
Oh, that's of course for an economist not an easy question to answer, and my answer may well fall short of being complete. I would say that first of all, this tells us business continuity is a big issue. We need to plan for it. We need to plan better. B, we are learning a lot about business continuity, having to work from home office. So I think business continuity plans and will be refined and will get a significant jolt. C, I think as to continuing businesses, probably almost everybody should be able to continue given the huge amounts of government help that are available. The real issue then is to think, if liquidity help from the government gets you over this, what happens thereafter? There will be some lasting changes, probably away from shopping malls into online shopping. There will be some lasting changes, probably a bit less long distance travel, more digital communication like we are doing. There will be some lasting changes towards healthcare, pharmaceuticals, and the like. That is, as there will be some lasting changes to the structure of demand, think about how your business is being affected, which side you're on. If you're affected negatively by these probably longer term trends, or by the trends that were there but now will be accelerated, then change the business model early on to be geared towards what is likely to be the new structure. Go towards where innovation will make a difference, because this is likely to be a significant jolt to the speed and dispersion of innovation.
Excellent. And then the final question that we have here is from Jay McDonald. Do you have a view on cross-border M&A post-pandemic?
Actually, I don't really have a view on the cross-border element of that. I would expect that within Europe, there will be a lot of it, and it will be easy. We will all in all likely, not immediately, but sometime after the crisis, have a significant shakeout, churning in the business sector, which of course opened up opportunities for cross-border mergers and acquisitions where it is allowed. On the other hand, we will likely have a much more strategic approach to these things. We will have governments looking closely. Do we actually want this to fall into foreign hands, or is this now part of critical infrastructure? So as to beyond the European market, you could say, beyond the common market, cross-border M&A, there will be more questions asked from a strategic point of view of governments. Do we actually want this? There will be more attempts to keep the Chinese out. There will be more questioning. Can we really rely on a company that is a US company if it comes to supply of critical infrastructure, of critical medical things in Europe? So outside the various common markets, especially the common market of the EU, outside that, cross-border mergers and acquisitions will probably face a headwind coming out of a more strategic approach to, you could call it, industrial structural policy.
Excellent. Thank you. Thank you for answering that question. Thank you for taking the time to meet with us and speak with us today, and to all who are attending. We really appreciate Dr. Schmieding for joining us and sharing such key insights with the GPs, LPs, everyone who's attended this webinar today. Thank you again, Dr. Schmieding. Thank you to Berenberg Bank for putting this on. Thank you to all who have participated for the excellent questions and filling in with the poll answers. We appreciate everyone for the time that you've taken to join us in this webinar. It's a pleasure hosting this to all of you. Please stay tuned to some of our upcoming webinars that you can see here. And we hope to see you all again. And Dr. Schmieding, stay safe. Thank you again. We'll share this out with everyone who's attended and answer some of the remaining questions via email once we send out this video with the with these slides.
Excellent. Let me thank you for your interest and also add to what you've just said. I know that there are quite a few questions which were posed, but which I could not answer. My email is easily available on the net, holger.schmieding@berenberg.com. If there is a question to me that you think I, as an economist, could usefully answer, don't hesitate to send me an email. And of course, nowadays, especially, stay safe. Thank you.
Thank you, Dr. Schmieding. Thank you very much. And thank you to everyone. Have a great rest of the afternoon. Stay safe. Catch us with our other webinars coming up.